Welcome to the Deconstructionist Deep Dive, the podcast that doesn't just accept the story.
We break it.
We examine the pieces.
And expose the machinery inside.
Let's dive in.
Let's dive in.
So our mission today, it's really a kind of intellectual interrogation. We're taking a deep dive into the architecture, the structure of self-made crypto wealth.
Right. And specifically, we're looking at a maximalist blueprint, this idea, this success story that claims it's completely broken free from the traditional financial system.
Exactly. We want to understand the engine, how this wealth was built. But maybe more importantly, we need to ask, is that engine actually sound? Or is it, fundamentally flawed, maybe even a time bomb?
And we're really questioning that central idea, the aspirational premise that fuels this whole digital wealth thing.
Which is?
What if everything about the crypto millionaire success story isn't just lucky, but is actively designed to hide catastrophic structural flaws? We're not looking at a failure story here. We're actually deconstructing a success to see what dangers might be lurking inside it.
And to do that, we've analyzed a very specific, very public case study. Chris, who many know as Crypto. We've traced his journey basically from being a taxi driver around the 2017 cycle.
Right, the big boom then.
All the way through these really turbulent market cycles, right up to 2024. And this blueprint, it's compelling because it gives us a clear set of maximalist beliefs to examine.
But also, crucially, quantifiable. Public holdings, things we can actually measure.
Right.
And that lets us do a real architectural analysis, not just talk about feelings.
Yeah, the numbers matter here.
Absolutely. Yep. That quantification is, well, it's the core of how we approach this. We're not here to, celebrate or condemn the guy himself.
No, not at all.
We're using this really extreme high-stakes example, this architecture, to try and spot dangerous thinking patterns that might be creeping into your own financial decisions.
Because you want to understand how risk works.
Right.
And understand it quickly.
And we think this deconstruction, looking at this extreme case, can give you those clear aha moments, especially about that lethal mix of concentration and, identity.
Okay, so let's unpack this engine first, see what actually built the initial success story.
The origin story itself is powerful. You can see the appeal immediately.
Oh, totally. It's pure gold for narrative appeal. A regular guy, right, a taxi driver.
Yeah.
And he becomes a multimillionaire across, two major bull cycles?
Yeah, primarily through really aggressive trading, but also content creation and very focused affiliate marketing, all inside the crypto world.
It's a definitive rags to riches story, but for the digital age. The dream.
But we have to push past that narrative, compelling as it is. Yeah. We need to anchor ourselves in the actual numbers, the structure of the wealth.
Okay.
So the primary vehicle here, the core asset. It's definitely Bitcoin, no question.
Right.
The portfolio has this really significant core position, 78 BTC.
And just to put that into perspective for people.
Well, at the time we looked at it, that translated to a realized, calculated profit base of roughly $3.65 million just from that core holding.
That's substantial. But it's also important, I think, to note the complexity here. He's not just a Bitcoin purist who ignores everything else, is he?
No, not at all. And that's a key point. He holds significant secondary positions, too. 146 ETH, last we checked, plus a very active mix of altcoins.
Like what kind of alts?
We're talking tokens like ORDI, BNB, XRP, we'll come back to that one, FET, Chainlink. It shows a strategy.
So these aren't just tiny bets.
No, they seem like strategic allocations. Across layer ones, foundational chains and also specific utility sectors, it suggests he's actually a pretty sophisticated position trader, someone using the volatility of the entire ecosystem to feed back into that primary Bitcoin position.
Okay, that makes sense. It's not just buy and hold BTC.
No, and what's structurally critical is how this whole thing is sustained. It's the income stacking. It's like a flywheel.
A flywheel?
How so? It's this multimodal revenue system. It's designed to pull capital in from 4 different directions and just constantly inject it back into crypto assets.
Right, you mentioned those. Trading profits.
Yeah, that's the high-risk, often high-leverage play. Then there's YouTube content monetization.
The whole influencer celebrity factor, bringing in eyeballs and potentially capital.
Exactly. Then affiliate marketing, which is almost entirely crypto-focused deals, pushing exchanges, services, whatever.
Like driving traffic, getting commissions.
And finally, seed round investments, which is basically the highest risk venture capital type play. You're making early, often illiquid bets on brand new protocols, hoping one hits big.
So 4 distinct streams, all funneling back into crypto.
Correct. And this leads us to maybe the most critical philosophical choice he makes. the settlement preference.
Okay. Explain that.
This is the detail that really separates this maximalist idea from just being a speculator. Whenever possible, every single dollar of profit, whether it's from a trade, an affiliate deal, YouTube, it gets immediately denominated and held in Bitcoin.
So USD is just a temporary step.
Exactly. It's viewed merely as a necessary bridge. It's not the measure of wealth. It's not the store of value. For him, wealth is strictly defined by how much Bitcoin he's accumulating, the rate of accumulation.
That's a very clear ideological stance.
It is. And that philosophical foundation, it really defines the architectural risk we're talking about. We can kind of distill it down into three core pillars, three core beliefs.
Okay, what are they?
First, as you just said, the definition of value. Wealth equals Bitcoin accumulation, not its USD equivalent. Full stop.
Which is, the classic argument against central banks, inflation.
Yeah.
Positioning Bitcoin as the only mathematically sound store of value.
Pillar 2 is total systemic rejection. Escape the traditional financial system and, crucially, avoid re-entering it.
And that's a massive commitment, isn't it?
Yeah.
It implies
What?
no traditional savings accounts.
No fiat savings, no brokerage accounts holding stocks or bonds, no relying on traditional banks for custody, and critically, no traditional diversification into things that aren't correlated with crypto, like stocks, real estate, commodities. At least not yet in his plan.
Right. The not yet is important.
And the third pillar is strategic, but also, I think, dangerously rigid. Cyclical diversification timing. He's operating on a specific 3-cycle plan.
3 cycles.
The idea is accumulate like crazy through the first few crypto market cycles, use that high volatility unique to crypto to multiply your capital much faster than you could elsewhere, and then, only then, at what you predict will be a peak, then you consider moving some of it into non-crypto assets, real estate, gold, whatever.
So it's like a calculated blitzkrieg. All or nothing, accumulate first, diversify much later.
Precisely. And this is the immediate glaring conflict we wanted to get at. There's this cognitive gap, a gap between the bold maximalist talk and the messy reality of how risk is actually managed day to day.
Okay, so the philosophy sounds bold, non-emotional, anti-system.
Yeah, the rhetoric is strong, but the actual risk management framework, when you dig into it, reveals massive accepted exposure and, honestly, surprising fragility.
How so? What does the execution look like?
The execution is this weird blend. It's long-term belief, sure, but combined with accepting huge short to medium-term volatility. His approach is basically position trading based on looking at monthly charts.
Monthly charts. So that means he's okay with potentially huge drawdowns over weeks or months, not just bad days.
Exactly. He's exposed to significant multi-month drops, and his stop-loss philosophy, well, it's terrifyingly simple. It's basically just a commitment to hold through all the volatility until either the position gets liquidated entirely or it eventually recovers. There's not much active risk management in the traditional sense.
And we know this approach has caused damage, right? There were documented losses.
We absolutely must acknowledge the documented financial hits, $400,000 in total losses. These are from acknowledged liquidation events spread across different phases of the market cycle.
$400,000.
Mm-hmm.
I mean, that's not just tuition, as some might frame it. That's capital that could have been used differently.
That's the opportunity cost perspective, absolutely. That same capital could have bought a guaranteed inflation-protected T-bill ladder, something totally uncorrelated, providing a liquidity runway for when the crypto market inevitably tanked.
But instead it gets framed as a learning cost.
Mm-hmm.
And he claims this complete emotional detachment, right? To see as numbers, completely non-emotional.
Yet the strategy itself repeatedly exposes him to potentially catastrophic drawdowns and, as we saw, accepted liquidations.
There's a real tension there.
It's fascinating. The rhetoric suggests, intellectual mastery, clinical distance from the money, but the execution accepts systemic failure getting liquidated as just a necessary quantifiable cost of doing business in crypto.
Whereas if a conventional fund lost nearly $500,000 like that,
it would be a full-blown crisis. Heads would roll, risk models would be torn apart. Here, it's almost a badge of honor, a data point used to reinforce the narrative of resilience, of having survived the storm.
And that tension, that gap between the story and the risk reality.
Yeah.
That's the first major vulnerability we need to dig into.
Exactly. That's where the architecture starts to look shaky. Okay, so now we bring out the scalpel. Let's dissect the core structural weakness here.
And it seems pretty obvious, right?
It's stunningly obvious, and yet profound in its lack of protection. Single asset class concentration.
It's not just like a heavy allocation. It's almost a declaration of faith, isn't it?
It really is. We are looking at a system built on 100% crypto exposure across all four of those income streams we talked about.
Trading, content affiliates, seed rounds, all crypto.
Across all the stored assets, primarily Bitcoin and ETH.
Right.
And across the entire generational strategy, at least for now. There's no off-ramp built into the current system. Not yet.
Meaning the entire thing, the whole edifice, is built on the premise that this one asset class, crypto and crypto alone, is the ultimate path to survival and wealth.
And he's been quite open about it. The subject himself admitted the stark reality, which is, commendably honest in a way.
What terrifying.
But terrifying in its implication. He said, if crypto goes zero, I'm at zero.
Wow. Just lays it out there.
In portfolio theory, this just violates the absolute cardinal rule of risk management. Diversification isn't optional, it's fundamental.
It's like building a skyscraper, but insisting on using only one material, say entirely out of high-grade glass.
Exactly. It might look incredible, maybe it's super efficient in some ways, super beautiful.
But the moment you introduce one unexpected shock, something that glass isn't designed for.
It's like a massive sudden temperature drop or a freak hailstorm or, in this financial analogy, maybe a single devastating regulatory ruling.
The whole structure becomes incredibly vulnerable. It could shatter.
Because the strategy is missing those traditional firewalls. There is a complete, almost defiant absence of assets that are uncorrelated or even negatively correlated to digital assets.
So no stocks, no bonds, no geographically spread out real estate, no physical gold or other commodities. At least not in this wealth accumulation phase.
None of it. Which, again, just goes against every principle of modern portfolio theory, which was developed specifically to handle these kinds of non-correlated systemic risks that can hit one asset class but leave others okay.
Okay, so if the risk is that stark, that obvious, how does someone rationalize maintaining that level of exposure?
Well, that leads us straight into the cognitive defense mechanisms, the mental tricks needed to justify it.
Yeah.
And the big one here is survivorship bias.
Right. The distortion field that protects the narrative, protects the identity.
The individual acknowledges, even says publicly that, yeah, this is a lucky story. He recognizes how improbable his outcome actually is.
Okay, so there's some self-awareness there.
Some. But in the same breath, he promotes this dangerous counter-idea that you can force luck through sheer conviction, through concentration.
Which basically reframes an outlier event. The tiny percentage who survive crypto's insane volatility with huge gains as if it's a repeatable, executable strategy that anyone can follow if they just believe hard enough.
That's the insidious part, and it's crucial to deconstruct how failure gets processed within this mindset.
Like those liquidation events we mentioned, the $400 K losses.
Exactly. Those aren't treated as evidence that the position sizing strategy failed or that the risk controls were inadequate.
They get called, what? Learning costs. Tuition.
Right. Which sounds proactive, like you learned something valuable. But if a traditional hedge fund kept incurring those kinds of losses due to the same strategy flaw, they wouldn't just call it tuition. They'd fundamentally overhaul their systemic risk model.
Here, it seems the risk model is almost designed to accept that level of loss, which conveniently obscures the fact that the system itself might be inherently flawed.
And the data presented is, by definition, statistically incomplete. Survivorship bias means we only ever hear the story from the one who made it through.
We don't hear from the presumably vast majority of people who tried the exact same high concentration, high conviction strategy.
And got completely wiped out. In the 2018 crash or the 2022 deep freeze, we just don't have that comparative analysis readily available.
So we're observing the exception, the survivor, and then trying to reverse engineer that exception into some kind of universal rule or dogma.
Precisely. And this constant tension, this need to maintain the narrative despite the risks, brings us back to the signs of cognitive dissonance.
Like the claim of being detached.
Yeah, the individual claims clinical detachment, see as numbers, completely non-emotional, but that just seems fundamentally incompatible with the very public performance required to build and sustain the crypto brand.
That's a great point. You see the documented, very public commitment to the success narrative, constantly displaying portfolio performance, tweeting market conviction.
That's not clinical distance, that's performance art. It has to be, right? It's designed to reinforce the identity, the crypto winner persona, because that identity is what generates the affiliate income and the content revenue.
If it were truly just about the numbers, wouldn't the portfolio management be, like, super private and boring?
You'd think so, but wait, let me push back on that slightly. Is the public luxury consumption, the Lamborghini SVJ, the private jets, is that purely cognitive dissonance? Or is it actually just smart branding?
How do you mean?
Well, the car isn't just a car, right? In this context, it's a vital marketing tool. It's visual proof of the crypto millionaire brand. It reinforces the belief structure for the audience, which in turn drives the content monetization engine. Maybe it's less dissonance, more calculated identity projection.
That's a sharp distinction. Calculated projection. But I'd still argue it reveals dissonance. Because the need for that external, super high visibility validation, the Lambo, the jet, it proves a deep emotional investment in the success story, doesn't it? If you genuinely see assets as just non-emotional numbers on a screen, you'd likely optimize for utility, for preservation, maybe minimize unnecessary exposure or cost. A Lamborghini SCJ, let's be honest, maximizes external identity signaling and minimizes practical utility, especially as a tool for long-term wealth preservation. It screams, "I made it," emotionally.
Okay, fair point. The choice of that specific asset signals something beyond pure numbers. And finally, there's the tribal factor. We can't ignore that.
Yes. You mentioned the reference to the XRP family.
That single word, family, applied to an investment. That's
Yeah.
lethal for objective financial analysis.
Because once an investment choice becomes tangled up with your social identity, your tribe.
You lose the ability to apply cold, hard logic. The community alignment, the feeling of belonging, it becomes this huge psychological barrier.
Other barrier to what?
To optimal exit strategies or to diversification, because selling the asset or even just reducing your position feels like you're betraying the family, betraying the cause.
So the financial decision gets warped into an identity decision. And identity is way harder to change than a spreadsheet number.
Exactly. The tribe resists objective analysis. Okay, let's move past the psychology for a moment, the defense mechanisms. Let's bring out the heavy analytical tools, the scalpel of financial science.
Because this maximalist strategy, like any strategy, rests on certain core assumptions.
Exactly, and it's built on a foundation of critical, unproven strategic assumptions. If even one of these fundamental assumptions turns out to be wrong,
The whole architectural plan could just collapse.
it could collapse, potentially taking the entire wealth structure down with it.
So what's the first big assumption we need to question?
The first, and maybe the riskiest one, underpinning the whole multi-cycle plan, is market cycle repetition.
The idea that crypto markets will just keep following the same patterns, like a 4-year halving cycle driving predictable bull and bear markets.
Precisely. The entire diversification timeline, the whole accumulate for 3 cycles, then diversify plan, is based on this rigid idea that historical patterns will just keep repeating.
Even though the market environment has changed massively.
That's the crucial flaw. This assumption criminally neglects what we call regime change analysis. We are now operating in a post-ETF world. Bitcoin ETFs are here.
Which brings in massive institutional players, changes liquidity.
Totally. We have unprecedented global regulatory scrutiny compared to 2017. We have sovereign nations getting involved. The whole game has changed.
So the idea that a strategy optimized for the, let's face it, pretty unregulated niche market of
Can
2017.
just be blindly applied to the professionalized, highly scrutinized, institutionally influenced 2024 landscape. It's not just naive, it's arguably financial negligence.
The old rules might not apply anymore, but the blueprint assumes they're set in stone.
Exactly. Okay, second assumption. This one feels even more like walking a tightrope.
Which-
Diminishing returns timing. The diversification plan doesn't just assume the cycle repeats. It banks the entire exit strategy on a predicted, very precise reduction in crypto's returns over time.
Meaning they think they know not only that returns will diminish, but when and by how much.
Yes. It requires predicting the market peak and the expected drop-off in gains for subsequent cycles with enough accuracy to time the diversification perfectly.
That sounds incredibly difficult.
It's a timing game that even the world's biggest quantitative hedge funds, armed with legions of PhDs and supercomputers, consistently fail to master. They're essentially betting billions on a predictive crystal ball that history shows just doesn't exist.
Okay, so assumption 1, cycles repeat identically. Assumption 2, we can perfectly time the peak when returns diminish. What's the third?
Yeah, the big one. The granddaddy of maximalist belief. The core ideological pillar. fiat collapse inevitability.
Right. The idea that traditional currencies are doomed to fail through hyperinflation and Bitcoin is the only lifeboat.
The entire long-term, non-diversified strategy is ultimately predicated on this belief that fiat will fail absolutely and catastrophically. That's the ultimate safety net in this worldview.
And while, concerns about government spending and monetary expansion are valid,
Of course. But this blueprint neglects the far more probable scenarios. Like, what if fiat doesn't collapse overnight? What if we just see incremental market changes, steady increases in regulation and taxation on crypto? Or just slow wealth erosion through inflation while other assets keep pace?
it's a binary bet, all or nothing. Fiat collapses completely, or the strategy might be suboptimal. It ignores that long, messy middle ground of slow change where diversification usually shines.
It's a bet on total societal collapse, essentially. Okay, so if you adopt this maximalist approach relying on these huge assumptions, you also tend to strip away the quantitative discipline, the tools that traditional finance evolved over decades specifically to manage risk.
Let's talk about those quantitative blind spots. What mathematical metrics are just missing from this kind of blueprint?
Well, first, there's a glaring lack of expected value calculations.
Explain that. What's expected value?
In sophisticated trading or investing, you don't size your positions based just on confidence or gut feeling. Expected value asks a simple question. If I risk X amount on this position, considering the probability of different outcomes, win big, win small, lose big, what is the mathematically weighted probable return or loss?
So it's about probability-weighted outcomes, not just wishful thinking.
Exactly. This maximalist blueprint seems to lack that mathematical foundation for sizing positions. It appears based more on conviction this asset must go up, rather than a cold, hard calculation of the potential payoff versus the actual risk taken.
Okay, what else is missing?
No evidence of Monte Carlo simulations. For a strategy this concentrated, this should be non-negotiable.
Monte Carlo. That's running thousands of simulations based on past volatility.
Right. It answers the terrifying question. Given my current huge concentration, my leverage, and the known historical volatility of this asset, what's the actual probability of ruin?
Ruin meaning going to zero or close to it.
Exactly. If you run, say, 10,000 simulated market scenarios based on historical data and your risk assumptions, how many of those scenarios end with your desired multi-million-dollar outcome? And crucially, how many end with you wiped out?
Without that probabilistic data.
You're basically flying mathematically blind. You're substituting hope for a calculated hedge.
Makes sense. Next blind spot.
We can't evaluate the quality of the success without looking at risk-adjusted returns, specifically something like the Sharpe A ratio.
So it's not just about how much money you made, but how much risk you took to make it.
Precisely. Yes, the nominal returns here look fantastic. $3.65 million in profit on the BTC alone is great. But was that return worth the gut-wrenching volatility, given the need to survive these acknowledged 70–80% portfolio drawdowns during bear markets?
And accepting $400K in liquidations along the way.
Was the return actually commensurate with the sheer amount of risk, the volatility that was endured?
Because a lower risk, maybe boring, diversified portfolio like a standard 60/40 stock bond index mix might yield a much better Sharpe ratio over the long haul.
It very well might, meaning the investor in the 60/40 got more bang for their risk buck. High returns coupled with absolutely catastrophic volatility often just means you took massive, arguably unintelligent risks and just happened to get lucky this time.
Okay. And the last missing piece.
Comparative benchmarking. You simply cannot claim your maximalist strategy is superior if you haven't bothered to measure it against the standard, boring alternative.
Like comparing it to that 60/40 portfolio, or even just a well-diversified crypto portfolio.
Exactly. This blueprint seems unable, or perhaps unwilling, to benchmark its performance against a standard risk-managed portfolio, whether traditional or even a diversified crypto one that allocates based on measured risk, not just tribal conviction or gut feel. Without benchmarks, success is just an anecdote.
And when we look at failure modes, these quantitative blind spots become really dangerous. Thinking about historical parallels.
Like the dot-com bubble millionaires back in the late 90s.
Yeah. Many achieved rapid wealth, sure. But a lot of those who actually survived the subsequent crash, who kept their wealth.
They had more diversified exit strategies, didn't they? They might have sold some of their dot-com stock for prime real estate or boring fixed income.
Right. They understood that while the technology, the internet, might win eventually, their specific company, or even the entire sector at that valuation, might still fail spectacularly.
This maximalist blueprint seems to reject that fundamental survival mechanism. It rejects the wisdom seen in successful long-term institutional models, like the Yale endowment model.
Which mandates diversification across many different non-correlated asset classes, specifically to ensure long-term survival and smooth out returns over decades.
The maximalist blueprint fundamentally rejects the mathematical imperative of redundancy, of having backup systems.
And quickly touching on the technical analysis aspect,
Yeah.
relying heavily on historical chart patterns like that 17K Bitcoin resistance level breakout as a long-term entry signal.
It shows a potential inconsistency, or at least a heavy reliance on patterns repeating in a market that, as we said, is fundamentally changing. Past performance isn't indicative of future results, especially when the players and rules are shifting.
Finally, there's the liquidation cascade risk. This seems critical.
It is. When your position sizing is set up to accept getting liquidated sometimes, you're making a very dangerous assumption.
What's the assumption?
You're assuming that market mechanics will remain stable and liquid, even under stress, that you can get out or meet margin calls in an orderly way.
But during a real market panic, a crash.
That's precisely when liquidity evaporates. Volatility spikes off the charts. Your accepted loss doesn't happen smoothly. It accelerates into a catastrophic cascade. Margin calls can't be met because there are no buyers at your price.
So the entire system fails because the core assumption that risk is manageable, even at extremes, just evaporates at the moment of maximum stress.
Exactly. The plan breaks when you need it most.
Okay, so we've dissected the math, we've used the scalpel, we've shown the technical architecture seems, well, brittle, built on shaky assumptions.
Right.
But now we have to pivot. Because maybe the most dangerous variable isn't the math or the market.
Yeah.
Maybe it's the human brain running the show.
Ah, the psychology.
Yeah, because even if the math is flawed, maybe the plan itself was sound initially, until we look at the execution, specifically this diversification delay.
That's the absolute critical pivot point, isn't it? We move from analyzing the risk theory on paper to looking at the failure of execution in practice.
Because there was a plan, right? A documented, systematic plan.
There was. The implementation timeline we found was quite clear. Cycles 1 through 3, roughly covering up to, say, 2021, 2022. That period was explicitly designated as all-in crypto accumulation.
The aggressive wealth creation phase.
Yeah.
Get as much crypto as possible.
Correct. But the plan then explicitly slated diversification for cycle 4 and beyond. That's when the shift was supposed to happen, moving capital into non-crypto equity, farmland, selective real estate.
You know, the classic hard asset transition, this stuff you do for wealth preservation, not just creation.
Exactly. Now, the subject is currently operating well into what should be that cycle 4 timeframe in 2024. He successfully navigated and survived 2 major bear markets.
So logically, based on his own stated plan,
Yeah.
he should be systematically diversifying now, putting those firewalls in place.
He even described the current status recently as the last cycle where I'm all in, implying the shift is imminent or underway.
But is it?
Well, here's the major contradiction, the gap analysis. The stated plan does not seem to match the current practice.
What is the current practice?
As far as we can tell from public statements and portfolio reviews, the practice appears to be continued 100% crypto exposure right through 2024.
So the structured, calculated exit. The installation of those financial firewalls we talked about, it's been delayed, postponed.
It seems so. The system, the strategy and action appears to be actively resisting its own planned escape mechanism.
Okay, why? What's the justification? What's the rationale given for sticking with 100% crypto when the plan said to start diversifying?
It seems to be a retreat back into the comfortable language of the maximalist safe space. The justification often boils down to buying and holding Bitcoin is the best.
Which is a belief, a mantra almost, not really an execution of the previously detailed diversification strategy.
Exactly. That rationalization, hodling is best, it actively resists and undermines the publicly stated, structured exit plan. It feels like the belief system, the emotional identity tied to being all in crypto, is overriding the calculated timeline that was supposedly designed for long-term wealth preservation.
Okay, so why does that happen? Why does the identity override the plan? This gets us deep into psychological risk factors, doesn't it?
Absolutely. This is where it gets really tricky. The public persona matters hugely here. Being known as the crypto millionaire, the hero figure for the decentralized revolution, that creates incredibly powerful exit barriers.
Exit barriers, meaning it's hard to actually sell.
It's hard psychologically and maybe even bad for business. If he starts diversifying out, systematically selling Bitcoin for, say, boring inflation-linked infrastructure bonds.
He's no longer the hardcore maximalist hero, is he? He becomes just another sensible risk manager.
And being a sensible risk manager is probably a less exciting and potentially less profitable brand identity for attracting viewers and affiliate clicks than being the all-in crypto guy.
So diversifying means potentially dismantling the very identity that generated the wealth in the first place. And maybe alienating the community following that sustains the income streams.
It's a real conflict, and it links directly to another psychological trap, consistency commitment.
We like to appear consistent, even if circumstances change.
Right. Strategies that you state very publicly, very confidently, they resist modification. Even when market conditions fundamentally change, like with ETFs, or even when you hit your own original self-imposed timeline for changing the strategy.
There's just intense psychological pressure, both internal and external, to maintain consistency for your audience, for your followers. It validates your past decisions, validates your identity.
And the wealth itself becomes so inextricably linked to the narrative of being all in that abandoning or even just adjusting that narrative feels like admitting failure, both financially and personally, even if adjusting is the logically correct move for preservation.
Okay, so because the system, driven by these psychological factors, is resisting the planned exit, the diversification.
It remains wide open, completely vulnerable to massive, unaddressed systemic risks, the very risks that diversification was supposed to solve according to the original plan.
Such as, what risks remain unaddressed due to this delay?
Well, first and foremost, regulatory event exposure. Because of the 100% concentration, a single, really adverse regulatory event in one key jurisdiction,
Like the US or Europe?
could be anywhere. A sudden hostile tax ruling on crypto gains, maybe a blanket ban on certain types of DeFi protocols he might be using, or even just stricter custody rules, could impact his entire structure because there's no diversification buffer in a different asset class or a different regulatory regime.
It's all eggs in one jurisdictional and asset class basket.
Pretty much. And second, relatedly, technological obsolescence.
Meaning Bitcoin or other current cryptos could just become outdated.
The core reliance is on Bitcoin dominance continuing and the stability of these legacy layer 1 chains like Ethereum, but that assumption ignores the incredibly rapid, often brutal pace of technological evolution in the space.
What if a new breakthrough happens? Like practical quantum computing threatening encryption, or just a radically superior, more economically sound protocol emerges that destabilizes the value proposition of the older coins.
If that happens, this wealth structure, being 100% crypto, offers zero protection. The inertia, the delay in diversifying caused by these psychological factors becomes a massive, ticking, systemic financial time bomb. Okay, so we've spent a lot of time deconstructing, taking apart this maximalist blueprint. But our goal isn't just criticism. It's about empowering you, the listener.
Right, providing superior, more robust, maybe even anti-fragile frameworks for thinking about wealth, especially wealth gained rapidly in volatile sectors like crypto.
Because if you are fortunate enough or skilled enough or lucky enough to achieve that kind of rapid, concentrated wealth, you absolutely must transition your mindset.
Transition from what to what?
From a speculative mindset, the mindset focused purely on wealth creation, to a preservation mindset, a mindset focused on long-term survival.
Because the maximalist blueprint, as we've dissected it, seems built almost exclusively for wealth creation, specifically within a crypto bull market. It lacks defensive capabilities.
Exactly. We need a framework that's built not just to survive a crypto winter, but potentially to survive true black swan event, something that could withstand the simultaneous failure, or at least severe stress, of both the traditional fiat system and the crypto system.
That sounds like a tall order. What kind of architecture could do that?
Well, the first powerful counter-architecture we should discuss is the barbell strategy.
Popularized by Nassim Nicholas Taleb, the anti-fragile guy.
That's the one. The model aims for anti-fragile positioning. It's designed to actually benefit from, or at least be immune to, extreme volatility and black swan events.
How does it work? Instead of putting everything in one place,
Instead of 100% concentration or even a mushy middle ground diversification, you allocate your capital to two absolute extremes. You avoid that mediocre exposed middle.
two extremes, like what?
You gain stability, your defense, from putting the vast majority of your capital in ultra-safe assets, and then you gain massive upside potential, your offense or optionality, from putting a small portion in extremely high-risk, high-reward bets.
So the idea is that no single event can wipe you out. The safe part protects you. The risky part gives you potential huge gains.
That's the core concept. Nothing in the middle can really hurt you badly, and you're protected from ruin on one side while having exposure to massive upside on the other.
Okay, let's get specific, though. What does that allocation actually look like? This is the actionable part for listeners.
The classic Taleb-inspired barbell would be something like this. 80% allocated to ultra-safe assets.
Ultra-safe meaning? What exactly?
We're talking assets that have near zero chance of losing significant nominal value and ideally protect against inflation. Think short-term U.S. Treasury bills, T-bills, inflation-linked bonds like TIPTIS in the U.S., maybe some high-grade sovereign debt from stable countries, and significant cash reserves. Physical gold could fit here, too, for some.
So this is the absolute bedrock. Your ultimate defensive position, designed to maintain purchasing power even if everything else goes haywire. This is the firewall.
Precisely. The 80% is your survival capital. Then the remaining 20% is allocated to high-risk exposure.
And this is where the crypto bets would live.
This is where your concentrated crypto positions belong. Or maybe angel investments, speculative biotech stocks, anything with that asymmetric risk profile, small chance of massive payoff.
Okay, so how does this protect you better than 100% crypto?
Look, if the crypto bet, the 20%, pays off exponentially, like the maximalist hopes, that 20% can still make the overall portfolio grow very significantly. You still capture huge upside.
Oh, the crucial difference.
The protection comes from the other side. If that 20% goes to zero, if the entire crypto market collapses, gets regulated out of existence, whatever the 80% firewall ensures your survival.
You don't lose everything.
You don't lose everything. You sustain your lifestyle. You have capital to regroup, reinvest, fight another day. You haven't lost your entire fortune based on one single bet. It's the logical, mathematically superior counter to 100% concentration risk.
Okay, the barbell makes sense as an alternative structure. What else? Are there other frameworks for long-term survival?
Beyond the barbell, we should look at incremental and generational frameworks. Strategies built not just for one market cycle, but for decades, for long-term survival.
Like what?
We'd strongly recommend implementing a rigorous, non-negotiable incremental diversification protocol.
Protocol sounds serious. What does it involve?
It means setting up a strict rule. Every single year, regardless of market conditions or your gut feeling, a small, predetermined percentage of your concentrated gains, say 5% or 10%, must be rebalanced.
Rebalanced out of the concentrated asset, like crypto.
Yes, moved out of crypto and into non-correlated, ideally non-sovereign assets. Systematically, mechanically, without emotion.
Why is that annual incremental step so important?
Because it achieves several critical things. Most importantly, it establishes and builds a liquidity runway that exists entirely outside the primary ecosystem, in this case, crypto.
So you have cash flow resources that are completely separate from your main bet and identity.
Exactly. Resources that aren't affected if crypto crashes or gets restricted. This protocol also naturally leads to smoother geographic dispersion of assets over time, which mitigates that single jurisdiction regulatory risk we talked about. It makes your overall wealth structure much more robust, more anti-fragile.
It forces the discipline that psychology might otherwise resist.
Precisely. And finally, maybe the biggest shift required is perspective. We need to shift away from thinking about short-term maximalist gains towards generational wealth.
Thinking beyond just this cycle or even our own lifetime.
Yes. True preservation requires holding assets that are likely to survive multiple economic regimes, multiple technological shifts, not just one volatile market cycle in a new asset class.
So what kind of assets fit that generational profile?
Typically, we're talking about inflation-resistant real assets. Things that are inherently scarce, essential to human life or commerce, and ideally produce cash flow regardless of which financial system happens to be dominant at the time.
Give me some examples.
Think prime agricultural land, farmland. People always need to eat. Think essential infrastructure ports, toll roads, energy pipelines, maybe water rights. Think carefully selected income-producing real estate in stable locations.
Things with tangible value, basically.
Tangible value, scarcity, and often cash flow. These are the types of assets that tend to maintain real value when financial systems, whether they're fiat-based or even crypto-based, face unprecedented stress or transformation. Generational wealth isn't built on maximalist conviction in one thing. It's built on redundancy, stability, diversification, and reliable cash flow.
And that's our deep dive for this week.
Remember, the most dangerous illusion is the one you don't know you're in.
But now you know. So we've really tried to show you the structural failures lurking inside a crypto maximalist financial blueprint. That over-reliance on narrative, the cognitive dissonance between the emotional identity and the cold, hard analysis.
The fundamental failure to calculate risk-adjusted returns, and that profound, almost defiant lack of diversification against systemic failure. Our analysis showed that this specific architecture, this single asset class concentration, it's essentially built to break under real pressure. The only reliable way to survive generating wealth like that is to transition rigorously.
Transition into a wealth preservation architecture, building that firewall between your potentially volatile identity and your stable, diversified assets.
Absolutely.
So here's our question for you. What single point of failure architecture in your own financial mindset are you finally ready to put on the chopping block?
And remember, that maximalist mindset isn't just about crypto, is it?
No, not at all. It's about any high conviction, high concentration bet or strategy in your life, financial or otherwise, that lacks a proper calculated hedge against failure. What's your blind spot?
Let us know in the comments. Question the narrative. Deconstruct the dogma. See the system.
We'll see you next time. Stay skeptical.